The market, but let's also get a conversation going. Varun Lohchab, Head of Institutional Research at HDFC Securities, joins us now. Varun, good morning and thank you very much for joining us. This is Pavitra. Like we were talking about it, we're just around 20 points away from all-time high levels. We have been talking about, getting to this level for a while now. But how do you see it trending from here? Because even now, like we were hearing out with the previous bites as well, the key concern is the kind of valuations that are present in the Indian market, especially when you compare it to the rest of the emerging market peers. Do you think that is something that is likely to keep a lid on the gains?
Yeah, good morning. Yeah, you're correct that overall, valuations are looking little stretched at these levels, because if you look at Nifty, it's trading at around 22 times this year, which is FY23, and almost 19 and a half times FY24. So I think the upside looks fairly limited at the index level. At the same time, a significant downside also looks, unlikely, given how the earnings are shaping up. If you look at the quarter gone by, while overall earning growth was muted at around 4%, bulk of the heavy lifting was done by financials, which led to almost 75-80% of the upgrades in our entire coverage universe, which ensured, and since that is the biggest sector with 35% weight in earnings, that ensures that overall, earning downgrades did not happen in our coverage universe. So there were no upgrades, but no downgrades either. And, we believe BFSI will remain in that mode for at least next 1 or 2 quarters. Next year, our earning growth forecast is around 13% for the entire market. So in that context, I think index upside looks fairly limited, given we are at a slightly stretched valuation. But I think bottom up, non-index stocks, you will still find investable ideas from a 12-18 month point of view.
Varun, morning. Rima here. Any tactical plays? I know structurally you're bullish on banks and autos, and the list is coming up, for our viewers. You like banks, auto, industrials, gas, insurance. But any tactical plays? Because towards the year end, you do have a lot of index rebalancing. Sometimes sectors which have been lagging end up doing well. And that's the case, say, maybe something like an IT, for instance, could do well after this 20-25% underperformance since the beginning of the year. Would you recommend any tactical plays?
Yeah, so I think on tactical basis, and if I look at the next calendar year, typically a lot of this rotation of money into underperforming sectors of the current year happens towards the end of the year. But sectors where we see that next year there could be meaningful upside would again be a bit from the value side. So something like oil marketing companies, could offer good upside in the next calendar year, given the fact that they are trading at very attractive valuations. IT, we believe, is somewhere in the middle. We are slight underweight on IT still, as we believe that the risk to while I think most of the downgrades are done, we still don't see much triggers for upsides or earning upgrades for next year. So I think IT is more like neutral to marginal underweight, but something like insurance sector again, which has been on the sidelines this entire year. To an extent, consumer staples vis-a-vis consumer discretionary. This entire year, it was consumer discretionary, which did very well, and now valuations are extremely stretched out there. Whereas consumer staples is looking tad better, given the fact that I think peak of the cost pressures are behind, and there should be some rural recovery. So I think some of these tactical shifts within sectors will happen, and one should get positioned in those sectors which did underperform this year, but I think still keep a bit of value bias vis-a-vis very high growth and very high PE sectors.
All right, got that. Varun, I know that you do like the auto space, but how much of an upside do you see? We've already seen quite a run up. And then within the auto space, how would you play it? Because, I mean, you could look at the two-wheelers, or are you looking at the standard passenger vehicles, the tractors, or would you, go for the EV play, something like that?
True. I think autos, a large part of upside has played out in this calendar year itself. But I think, like banking, there is still some room left, which will, which you will get upside in the first half of next calendar year. In autos, our top picks right now are M&M and Maruti. These two are the significant overweights. But I think even two-wheelers could be interesting. They could be, your that potential turnaround dark horse kind of place, something like Hero MotoCorp, where again we are positive, if there is a bit of rural recovery, then valuations are extremely attractive out there. So, yeah, I think some of these are topics. iShare limited upside, TVS, while we like the stock and we had it in our model portfolio, valuations are starting to get stretched. So, we would stay away from some of these names.
What about railway-related PSUs? Is that a space that you've analyzed, Varun?
No, sorry, we don't cover that segment. But overall, in industrials and infrastructure, as a broad space, we are positive on. So names like Cummins, we have among our top picks. Something like KNR Constructions and Nagarjuna NCC, we are positive on. But the issue in that space increasingly is that, especially in the capital goods, not so much in construction, is valuations have really run ahead of earnings. So we wrote a piece on how capex cycle is looking sustainable this time around, and you will see that over next 2 to 3 years. But the problem is finding stocks because they are already pricing in next 3 years of earning cycle. So I think one has to be slightly selective and cautious in capital goods sector, given the way valuations have moved up in last 6 to 9 months.
Okay, Varun, just one final question before we let you go on the defense space. Of course, we've been talking about the kind of sharp up move that we've seen in a lot of these names, the likes of Hindustan Aeronautics or Amazon Dock. What do you think of these?
Yeah, I think, while we don't cover some of these names, so I won't be able to give stock specific views, but overall defense as a segment in our capex note also, we said that looks like the most sustainable part of, capex story of India for the next 8 to 10 years. So, I think the spending from the government on this segment looks sustainable and can continue to grow at 15 to 20% CAGR for a long period of time. The issue is, I think, how to pick the stocks, given the fact that valuations are already starting to reflect that. But as a segment, I think it's one of the most strongest sort of segments within the capex theme from a 5 to 10 year point of view.
All right, Varun, we're going to leave it at that today. Thank you very much for joining us and taking us through, how you see the market trending from here on. With that, let's actually take a look at the market because it is just around 20 points away from its all-time high level. Sensex, of course, has hit that level. The Nifty today, a large part of the up move coming through from the auto names. The IT pack has really surged in the last hour, so do keep that. Actually, that index is now perhaps the top gaining index sectorally also on the Nifty, just around 22 points higher on the Nifty. So we're very, very close to those all-time high levels. We're going to wind down on this edition of Trading Hour, but you guys stay tuned. Halftime report is up next.